how big of a pullback will it take to get you back into things?
Yeah, it's a good question, because I agree with Scott. After such a massive move, NASDAQ up almost 30% year to date, S&P 14%, it is normal to have a pullback. But I thought that a few weeks ago, and we haven't seen it. This market wants to go higher. You've got retail investors trying to come in. Institutional are underinvested. So I think any pullback we have will not be deep, and I think it'll be shallow and it'll be short. So that is, it's a tough question. It's like, the famous Supreme Court justice who said, "Hey, I'll know it when I see it," when referring to the test for pornography. You will see how the rest of the market is acting, but I don't think it will be deep. I think there's too much. I think the market is already discounting 1 to 2 more hikes, meaning the Fed is nearly done hiking, and I think that's what we're seeing in the market.
There are early signs of investors fleeing from tech stocks after 1999-like rally formed a baby bubble. According to Bank of America, the technology sector saw $2 billion outflows, the largest in 10 weeks, in the 5 trading days through June 2023. Investors exited with the NASDAQ 100 index up 38% for the year and poised for its best half since the last 6 months of 1999, when it surged 61% after climbing in 26% in the first half. Retail investors embraced stocks ahead of this week's slide. They scooped up $4.4 billion of equities during the week. The rally in U.S. stocks stalled this week as investors digested Jerome Powell's outlook on monetary policy.
It leads us to our talk of the tape. Is the tech exuberance fading? Let's ask Dan Greenhouse of Solis Alternative Asset Management. He joins me here at Post 9. Good to see you.
Thank you for having me.
Is the tech exuberance fading? It's been a strong run that nobody predicted year to date, month to date, and now some give back. Not extreme, but down for the week.
Not extreme, but every rainstorm has to begin with but a single raindrop, if that's what you believe.
So this is a rainstorm?
Yeah, I'm not saying that. The saying is apropos. Listen, you've had a terrific run in a lot of these names, as everyone is well aware. Apple on down through NVIDIA are up 30, 40, 50. NVIDIA is up almost 200% year to date. The law of large numbers kicks in at some point, and so it wouldn't be, whether in retrospect or at the moment, out of the realm of possibility to argue that most of those gains have been realized, and perhaps some give back or at a minimum a pause wouldn't be out of step with history.
The Federal Reserve Chair said more interest rate increases may be needed this year at a time equities have been climbing on hopes that rate hikes would end soon. Investors waited and waited. Then they moved all in chasing the markets. And now fund managers who are finally surrendering to a shock and unexpected first half rally in equities must contend with the possibility its best days are over, at least for now. Whether this sell-off is just a short breather on a longer uptrend or a peak.
So maybe it was too good to be true that tech was rallying in the face of tighter policy and higher rates.
But since we brought up the central banks, one can't hide from the fact that central banks remain way more hawkish about inflation than does, or as appears to be, the market.
Yes.
The market continues to not believe what the Fed is doing. They haven't believed what the Fed will do for 6 or 9 months.
Market thinks there'll be one more hike.
I would argue, listen, most of the street is, from the economic side of things, appears to me to be at 0 or even 1. I think there's maybe 2 shops that are at 2 hikes. Citi, Andrew Hollenhorst is at 2, and I think our mutual friend Michael Gapin over at Bank of America is now at 2. Everyone else is at 0 or 1. But this has been the story over the last 6 or 9 months.
But the counter argument there is that they're closer to the end.
Sure.
And even if it's one or 2 more, bell's not going to ring when they're done.
That's right.
They're getting to the end. I think the bigger question is how long they stay at this high level and when they start cutting.
I totally agree with you.
And does that change your view on when you should be buying tech stocks?
Listen, absolutely. I think the idea that one more hike is the straw across the camel's back, sure, maybe there's some evidence there, but at the end of the day, we have no way of knowing whether 1 or 2 more hikes is it. But with respect to what you said, the longer you leave rates up at an elevated level, the more ocean you're chumming, so to speak, the more refinancings that are going to get difficult, the higher interest expense for on-the-bubble companies are going to be, the more projects or investments that get put off because your hurdle rate is elevated. And again, the longer you leave things up there, the more of that starts to accumulate.
Yeah.
And traditionally, that's ultimately, that more than one more hike is what tips the economy over into a recession. And if that is what happens over the next, call it 6 or 12 months, then you don't want to really buy anything on an absolute basis, let it be tech or industrial.
The fallback comes at an uncomfortable juncture for Latecomers who, for months, resisted the temptations of the tech rally that looks fragile under the threat of economic slowdown. Staying sidelined or explaining to clients why you sent out a 40% rally is the conundrum facing investors who may have already missed out on the early and biggest gains. So if markets continue to go up, there may be more fund managers joining in the chase for fear of missing out and fear of being fired.
I am curious, Chris, about that here, because remember, this was kind of the discussion heading into this year. That was the surprise that those worst case scenarios didn't materialize. But we started to see a lot of softness in the economic data. We got global PMIs this week that showed that Europe's still in deep contraction, at least in the manufacturing sector. And the U.S. side isn't doing much better either.
But Romaine, despite all that bad news, European stocks are near their all-time high. U.S. stocks are near their all-time high. Look, my fiscal year end is June 30, so I am getting right to the finish line. I just want to keep going at least another week before, as Sarah said, kind of the reality sets into this market. Romaine, we have been predicting a recession since almost last summer. And yet here we are again. I'm going to tell you, there's likely a recession somewhere in the next 2 quarters. Yet this market defies gravity and keeps climbing. So this last week was a rough week. But hey, after such a run for 5 weeks, it's got to stop and catch its breath. The question, I think, as Sarah is saying, what is the future? It's about earnings. And there's a lot of headwinds that would say we should slow.
Well, Chris, let's talk about earnings here. We're about 3 weeks or so before we get the start of the fresh earnings season. And there is concern here that maybe some of the resiliency we saw over the last couple of quarters, the quarterly reporting seasons, that might not necessarily hold up when we get the results in mid-July and through August.
Romaine, I was surprised at that resiliency, but it came from this, the incredible stimulus during COVID, and it has hung on for a whole year, kind of beyond COVID. I mean, it's still with us, but the reality is we have been all shocked at how strong the consumer is, the employment numbers, the fact that, jobless claims was flat and steady this time is maybe a sign that we're going to start to see a buildup of unemployment. I've got to listen to Powell, what he said during his testimony, that he's willing to sacrifice employment and economic growth to kill inflation.
Well, Sarah, what does that mean, though, for investment allocation? We know, at least in the equity space, particularly here in the U.S., tech stocks, and particularly we talk about software and semiconductors, really led this rally here. Is there a case to be made to be exposed to other sectors?
There is probably more defensive. We've added a considerable amount of consumer staples as a place to get both income and stability. Those low beta stocks could be very useful in the next 6 months plus. It's hard to predict timing, but I'm on the same page as Chris. I'd add to that is it's not just earnings, there's liquidity too. And liquidity should be draining out of the monetary system globally, with the exception of China. So the Fed is going to take $1 trillion off its balance sheet, supposedly every year for the next couple of years. That's a tremendous headwind. So being a little more defensive, and not to mention the cyclical stocks, as Chris mentioned, have really run. I mean, why have materials and industrials and financials done so well before the recession? It's really extraordinary.
Is that based on, do you think people are buying into the idea of the economic cycle, or is there something different driving that, Sarah?
I just think nobody wants to get left behind. And clearly the big winners year to date have been information technology, communication services, but some of these cyclical areas outside of energy, which was last year's winner, which has been pretty soggy this year, the rest have done surprisingly well. And maybe it's just a disbelief that there will be a recession.
It will be a recession. And Chris, we have to point out, too, when we talk about the rally that we've seen in equities, this has been truly, indeed, been a global rally. You mentioned, of course, Europe, equity indices camped out near record highs. We, of course, knew last week the Nikkei over in Japan hit a record high. And while U.S. stocks aren't quite back to their record highs, it's still been an impressive turnaround from where we were even just, 6 or 7 months ago.
Romaine, it's been weird. And I mean, in the technical CFA sense, complex idea, it's weird. Seriously, a global rally, when you said that, you're getting weak industrial numbers out of Europe. And on top of that, what a narrow market. I mean, for up until 2 weeks ago, it was 9 stocks. I don't know, Sarah, as an active manager, how you make money in a year where it is so narrow and the breadth in the market is so bad. over 500 or 250 of the S&P 500 stocks are actually down on the year so far here in 2023. So, Romain, like you know, we own the market, so and we're global. So we've capitalized on the fact that Europe and Japan have done so well, and the U.S. has done so well. But I'm leaning defensive as we get into July and across the summer.
Thanks for watching. Share, like, and subscribe.